And thank you so much, India, for an opportunity to give a speech at the wonderful conference. Today's title is the role of green finance in pension investments. And if you look at the page 2, it is a GPIF in numbers. Can I go to the page 2, Natalie? Okay, thank you. GPIF stands for Government Pension Investment Fund, but to prevent any misunderstanding, we do not manage the pension reserve fund for public servants. We manage the fund for countries, private sector employees, and the people who are self-employed. GPIF is the world's largest pension fund, managing $1.4 trillion as of the end of March 2020. We own more than 5,000 stocks and almost 14,000 bonds, and our investment horizon is over 100 years. Because of our large and diversified portfolio and the very long-term investment horizon, we believe that the sustainable growth of investing companies and the capital market as a whole are vital in enhancing long-term investment returns. This is why we promote ESG integration throughout all of our investment processes. For example, at the end of March 2020, we had $53 billion invested in the funds tracking ESG indices and $4 billion invested in green, social, and sustainability bonds issued by multilateral development banks. And page 3 shows ESG in equity investments. In addition to efforts such as driving ESG integration and stewardship on the asset management side, GPI directly incorporates ESG into its portfolio at a high level by selecting a variety of ESG themes indices as benchmarks for passive managers. We believe passive investments based on indices that integrates corporate sustainability will not only improve the risk-return profile of our portfolio over the long run, but also enhance the Japanese equity market through secondary effects, such as the improvements of ESG ratings. The first 3 indices on page 3 are comprehensive ESG indices, I would say, developed by FTSE and MSCI for Japanese and non-Japanese international equities. The next 2 indices developed by S&P focus on the ever-worsening issue of climate change by targeting corporate greenhouse gas emissions. These are designed to reward companies with a higher green gas efficiency and a more active disclosure of greenhouse gas emissions information with a higher investment weight. And last 2 indices developed by MSCI and the Morningstar focus on the gender diversity of Japanese and non-Japanese companies. And the page 4 shows ESG and fixed income investments. GPIF and the World Bank Group have been working together to promote ESG integration and fixed income investments through efforts such as publishing a joint research paper entitled Incorporating ESG Factors into Fixed Income Investments in 2018. Following up on this research, the IBRD and the IFC, both members of the World Bank Group, drew up a new proposal in April 2019 to provide GPIF's external asset managers with an opportunity to invest in green, social, and sustainability bonds. GPIF provides external asset managers with an opportunity to both integrate ESG into their fixed income investments and gain excess return over government bonds by building platforms in which they can invest in green, social, and sustainability bonds and other securities issued by multilateral development banks and government finance agencies. This initiative has subsequently expanded to include 8 other multilateral development banks. In addition to that, we have also signed partnerships with government finance agencies such as KfW in Germany, Community Invest in Sweden, BNG Bank and NWB Bank in the Netherlands, KBN in Norway, and the EDC in Canada. And page 5 shows ESG in alternative asset investments. The holding period for alternative assets, namely infrastructure, real estates, and the private equity, is generally quite long. And in some cases, the asset manager itself is involved in the corporate management and the business operations of the investee. As a result, more asset managers are integrating ESG factors into the investment process in order to identify and understand the risk encountered during the holding period, and conversely, find opportunities for sustainable asset value growth and improvement of corporate value. This trend is particularly prominent among overseas asset managers. GPIF is implementing initiatives to ensure appropriate integration of ESG in the selection of asset managers and the subsequent monitoring. In addition to environmental risk assessments and the promotion of the energy efficiency measures, the real estate industry is increasingly focusing on initiatives to promote the health and the wellness of tenants. Properties that incorporate these ESG elements are not only attractive to tenants, but also recognized as investments with high risk resilience. The infrastructure market is witnessing a surge of investments in the renewable energy projects such as wind and solar power. The amount of investments in the renewable energy assets within GPIF's infrastructure investment portfolio is also increasing in major regions. And could you go to the next slide, page 6? The left-hand bar chart on the page 6 shows the carbon footprint of our equity and the corporate bond portfolio. The scope of GHG emissions includes each company's direct carbon dioxide and other GHG emissions. I mean, I'm talking about scope 1. So in addition to CO2 emissions generated by the purchased electricity and the first tier of the supply chain, I am talking about the scope 2 and scope 3. Looking at total emissions by asset class, domestic equities were found to have the highest level of emissions, followed by the foreign equities, domestic corporate bonds, and the foreign corporate bonds. And this does not necessarily mean the domestic companies or Japanese domestic companies are less carbon efficient than the non-Japanese foreign companies, but rather reflects the relative size and the sector holdings of each asset class within the GPIF's portfolio. Domestic equity portfolio has a higher proportion of the market capitalization invested in industrials and the consumer discretionary companies, which have, relatively speaking, high level of greenhouse gas emission volumes, while the non-Japanese foreign equity portfolio has a high proportion in information technology companies and the financials and the healthcare companies, which are sectors with a relatively low emissions. And looking at the breakdown of emissions by scope, in the case of domestic equities, indirect emissions comprising scope 2 and scope 3 emissions exceed direct scope 1 emissions. So illustrating how important it is for companies to consider their supply chains when formulating their GHG reduction strategies. And the page 7 shows the carbon intensity of our equity and the corporate bond portfolio denominated in the CO2 equivalent tons per million yen of sales. We decompose the change in the carbon intensity from fiscal 2018, beginning from April to fiscal 2019, into changes in corporate profits, corporate emission volumes, weight of each company in the portfolio, and other causes. As you can see, carbon intensity decreased by 15.3% from 2.29 tons to 1.94 tons in the space of a year. The largest contribution was from the change in the company's weight in the portfolio. As I have told you, GPIF began investing part of its equity portfolio in carbon efficient indices, which are designed to overweight highly carbon efficient companies. This is most likely one of the reasons we see this decrease in carbon intensity. So in addition, there was an overall decrease in the corporate emissions volumes and higher corporate profits due to favorable economic conditions in fiscal 2019, which together resulted in a lower carbon intensity. And last slide on page 8. I would like to introduce the climate value at risk, or CVR, of our equity and the corporate bond portfolio. And a CVR can be used to analyze impacts of both risks and opportunities on corporate value as measured by the value of both equities and the corporate bonds. So weighted average CVR is greater for domestic equities than for non-Japanese foreign equities. This means that the present value of Japanese stocks is estimated to increase by 12.3% under the 2-degree Celsius scenario. Environmental technologies provide an overall boost for Japanese domestic equities overall, despite the negative impact of fiscal risks. Although foreign equities have a smaller exposure to fiscal risks, the negative pressure from climate change risks overall is greater than climate change-related technological opportunities. Corporate bonds show different trend than equities, with a few technological opportunities seen in either the domestic or foreign bond portfolio due to factors such as sector bias. I attached a breakdown of CVR in the appendix, and we also have more detailed analysis on our website. So I appreciate if you could check our latest ESG reports or relevant reports. Thank you very much.
Thank you very much. I think we can stop sharing slides now. And let me introduce Brett Hammond from the Capital Group, who's going to be engaging with Tetsuya-san, Oishi-san, sorry, to discuss some of the points that were raised. Brett, you can unmute yourself.
I wonder if I could ask a question. And that is, I actually have a couple of questions that I think our colleagues in other pension plans will be very interested in, especially in the United States. And one of the questions is, you talked about GPIF integrating ESG considerations into its portfolios. And at the same time, it has a little less than 60 billion US in separate ESG stock and bond portfolios. I think that people will be looking to GPIF from other pensions and asking what should we be doing if we're not doing it already? And the question here is, why have any separate accounts at all? Why not fully integrate ESG into the portfolio and not have any separate accounts? Or put it another way, why not have completely separate accounts?
Yeah, very good question. Thank you very much. And we integrate ESG into our whole investment process, but then we would like to, at the same time, we would like to keep our tracking error to our policy benchmarks. So therefore, we do not fully invest it into the ESG indices, or we do not make a whole bond portfolio on green bonds once. And the GPIF Act clearly stipulates that the pension reserve fund must be managed for the sake of policy members, and the benefit is construed by the government as a financial risk. So we do not sacrifice our financial risk for the sake of ESG, and I personally do not want to burnish my burnish my personal career at the expense of people's important nest egg. So that's the long answer to your question.
No, but this is very helpful, because there are pensions, that we all know about, who are asking these same questions and trying to figure out, how do we balance fiduciary responsibility to the policyholders with both financial and ESG concerns. So it's very helpful to hear your comments. You mentioned orienting the portfolio toward the policy portfolio, toward various kinds of benchmarks, both market benchmarks and ESG benchmarks. This raises another question, which is the choice of an ESG measurement system or set of metrics can be a challenging one for any asset owner. We know that there are different metric systems out there and different weights to assign. How has GPIF addressed the challenge of choosing the right metrics?
Yeah, another wonderful question. Thank you very much. And so we look at the ESG ratings between MSCI and FTSE, and we found almost zero correlation between them. So it is the common headache for all asset managers. But I think it's currently converging into some common ones. And we do not regulate ESG, ratings or ESG metrics. It should be, formulated in the markets. And I think government shouldn't meddle with ESG ratings. Yeah.
No, I can see your point, absolutely. And of course, we have other people at the conference here, such as Linda Elling-Lee from MSCI and others who've been very interested in this question over time. So let me now turn to your last slide a bit. I know that you've urged people to go look at the appendix and go look on your website. But I know that people at the conference are very interested in the Sivar approach, because the end product is quite simple, and it's a way for people to see in a single measure or that's sort of easily understandable, and because it summarizes a range of risk types. Just wondered if you could say a little bit more about it. How did you develop it? What are the things that you wanted to include and didn't want to include, and how do you use it?
Okay. I'm sorry.
Well, I can take one at a time if you want.
No. We estimated Sivar in collaboration with the MSCI and in line with the TCFD directives, and we think the climate is the largest possible risk for portfolio, actually the Japanese government declared to be net zero by 2050, and many countries follow suit, and your new presidents will promise to go back to the Paris agreement. So the world is world governments is working together to this risk. So we think it's a serious risk. And as you can see on the page 10 to 12, Sivar is comprised of the policy risks, technological opportunities, and physical risks and opportunities. And physical risks and policy risks are negative for assets, but technological opportunities are positive for Japanese domestic equities, particularly. And MSCI, calculates these technological opportunities by looking at the patents, applied by Japanese companies and non-Japanese companies, and then they found that there are many good car manufacturers in Japan, and they have good technology to mitigate CO2. So this is that's patents shows up as the technological opportunities, particularly for Japanese companies.
Very interesting, because you have both positive and negative elements to the Sivar measure, which is I think very, very interesting. You just as a little follow up on that, how should other asset owners, pension funds, sovereign wealth funds, et cetera, how should they think about this? Should they be using something like Sivar?
Yeah. So the easiest way is to hire MSCI, but I don't think every asset manager shouldn't hire MSCI. But then I think in line with TCFD directives, I think it is one of the good way to look at the opportunities and the risks. But then I think there are other other metrics.
Well, thank you very much. And I have one more question.
I wonder if I could just interject a question.
Oh, sure, go ahead.
So this is fascinating, Oishi-san. So you, I think, have made a very good case for the impact of environmental and sustainable factors in deciding which way you want to go. But ESG has three components, the third one being G, governance. And in the US, we talk a lot about worrying about things like staggered boards and poison pills and governance topics. And I was just curious, is that something that is less salient in Japan, or are we just coming up with different criteria?
Yeah, good question. Thank you very much. And to be honest, I think, many Japanese companies are struggling to catch up with American or European companies, but to be honest, it is still lagging. There are a few, female directors, lack of diversity in the boardroom, and many companies are not internationalized. So many, Japanese male, employees are having titles at the major companies. But government is urging to change the corporate governance of the Japanese companies by introducing a corporate governance codes and a stewardship code for asset managers. So I think it is changing.
Oh, yes, and I mean, the governance question is a very important one. And one of the things that we've learned along the way in preparing for this conference is just that one of the things that you see between countries is that some countries are ahead on E, some are ahead on G, some are ahead on S, and so we're all learning from each other. One of the things that the last thing I wanted to ask was about green bonds. It seems like when you were talking about green bonds that GPIF has helped encourage new issuance in this area. And I just wondered if you'd say a little bit more about that, because one of the issues is the disparities between supply and demand.
Yeah, thank you very much. So that's why we partner with the many multilateral development banks and the government of financial institutions to provide a preferential access window to green bonds or social bonds or sustainability bonds to external asset managers we hire. But then again, so we do not sacrifice our financial returns as long as green bonds or social bonds or sustainability bonds provides a better risk return profile than we ask asset managers to invest in. So But
it seems like GPIF has been helpful in getting people to issue green bonds. Is that true?
We try to promote these markets, but still we do not urge issuers to issue green bonds. It's up to them.
Yeah, of course.
Well, I have one last question, please, if I may.
Please.
So you make the point that many times the asset managers might get involved in the actual management of the companies who are doing the sustainable investments. So if the investor does become involved in the management to make sure that the green investments are good products, does this make green investments more expensive to identify, to manage? And how does this affect the pension fund's capacity to include them?
You made a good point. And I think, to be honest, some green finances is quite crowded. Particularly, solar power in Japan is quite crowded, and expected return has been dropping. It is true, but then again, I have told you today many governments are working together to net zero by 2050 or 2060, so that this will create disruptional risk and also the disruptional opportunities for many of us. So I think we would like to look at that opportunity.
Interesting.
Any further questions, Brett?
Well, I'm sure we can go on for a very long and deep conversation, but I think we've at least gotten some very good ideas from Oishi-san, and I want to thank him.
Thank you so much. Very, very grateful. Appreciate it. And we'll look forward to talking to you in person one of these days in Tokyo.